How would it sound if I said there was a fund that pays 13% in dividend yield and pays you every single month? Well, that actually exists, and it's called the QYLD, and it's a covered call ETF. In this video, I wanted to tell you about what the QYLD is. Then I wanted to talk to you about how much you would need to invest in the QYLD to be able to retire purely off of the QYLD dividends. And then right at the end, perhaps the most important bit, and that's some pros and some risks associated with being an investor in the QYLD. Firstly, just for some background, please feel free to use the timestamps in the description below if you do want to hop around in this video. The QYLD was founded in 2013, but it only really started trading in early 2014. And it's an ETF, and it follows a covered call strategy. So it's not the same as your average ETF that you've heard all about, and it's also definitely not the same as the iShares Nasdaq ETF or the Invesco QQQ. QYLD is tracking an index. It's tracking the Nasdaq 100 index, and this comprises of Nasdaq's 100 largest companies. It is extremely tech heavy. It's really heavily weighted in tech companies, so please bear that in mind as it will be important when we discuss some of the pros and some of the cons later on in this video. So we've said that the QYLD is tracking this Nasdaq 100 index, but we've also said that it's not the same as other Nasdaq 100 trackers. So what's actually unique about it? Well, it's because it's what is called a covered call ETF. So let's first talk about what a covered call ETF actually is. The QYLD buys all of the stocks within the Nasdaq 100, and then it sells call options against the index itself. So what do we actually mean by call options? Well, an option is a contract, and it gives the buyer the right to, but not the obligation to, buy the Nasdaq 100 at a particular price within a specific time period. So the QYLD is basically selling these options to buyers who want to buy them, and these buyers are willing to pay a premium in order to get that right. And it's important to note that the QYLD works to a 1 month time period. If the Nasdaq 100 index reaches a price at the end of the month that is higher than the price laid out in the call option, then the buyer will call QYLD's shares. The reason the buyer would want to call the shares from the QYLD is because that way they will get the shares at a cheaper price than what they locked in at. If the index price either goes below the set price or it is the same as the set price at the end of the 1 month term, then QYLD keeps the shares, meaning the buyer does not call the shares. In any of these scenarios, QYLD always keeps the premium that the buyers pay. And this is exactly how that QYLD is able to pay these big dividends to their investors. But ultimately, the QYLD wants the price of the index to remain just below the call option set price, because this way they will get to keep the premium and also the shares, not just the premium. Now let's speak about how much you would need to invest into the QYLD to actually live off its dividends and how many shares you would actually need to own. The whole idea that you can invest into something and then be financially free because you're living off just the dividends of that investment is absolutely crazy. But how does it look for the QYLD? Time and time again in my videos, I've assumed and used the 4% rule to work out how much you would need in order to retire. Basically, you calculate your annual cost of living, you multiply it by 25, and this will give you your pension pot amount, and then you would withdraw 4% from that amount every single year, and it would never run out. Normally, when you look at, let's say, an S&P 500 ETF, you would do $30,000 a year if this is your living cost per year. You'd multiply it by 25, and this would give you £750,000 that you would need invested into the S&P 500. And this just really shows that you would need to invest an awful lot of money into these sort of funds to live off them in retirement. If you required $40,000 a year to live off, then this figure would go up to 1 million using the 4% rule. When it comes to the QYLD, the dividend yield is extremely high. On average, it sits at about 12%. So theoretically, with a 12% yield, you would only really need £250,000 to be able to live passively off of its dividends that it pays out to its investors, and you'd live on $30,000 a year. Let's now delve a little bit deeper into the numbers and work out how many shares of the QYLD you would actually need to own to be able to live off just the dividends in retirement. QYLD pay approximately 20.2 cents per share per month. Now, this is an assumption because one thing about the QYLD is that they're not consistently paying the same dividends. So to be able to generate $30,000 a year, which is $2,500 a month, how many shares of QYLD would you actually need? So to do this, we would take $2,500, which is the amount that we're looking to generate every single month in dividends. We'd divide it by 0.2, which corresponds to the cents per share, and that will give us the amount of shares that we would need in the QYLD, which in this case is 12,500. At the time of filming this video, shares of QYLD cost $20.85 each. So this means you would need to invest $260,625 into the QYLD to be able to generate $2,500 every single month. You'd also need to account for inflation. But what I'm just trying to show you here is that with the QYLD, you would need to invest a lot less into it in order to be able to live off the dividends than you would perhaps another ETF or even an individual stock. It's now time to look at some of the pros of the QYLD. But after that, we're going to touch on some of the risks, some of the cons of the QYLD as an investor, and it's really important that you stick around for that. Perhaps the biggest reason people actually invest into the QYLD is because it has a really high income potential. The dividends are extremely large, and right now the dividend yield sits at about 13.4%. And maybe the second biggest reason people actually invest into the QYLD is because they are monthly dividend payers and have been consistently paying out monthly dividends for 8 years. Some investors may not care about when they get paid their dividends, but for other investors, a monthly dividend coming in consistently is a real bonus. And the final pro of owning the QYLD is that it's a good thing to own when the markets aren't so good, as call options can be sold to generate an income if there is a flat market or even if there's a slight bear market. If there isn't really much going on in the market, then having the QYLD is pretty nice because you can just enjoy its dividends coming in. But often investors want to track the market and they want to bet that the market will rise. So I guess this ETF is kind of like a hedge against bad markets or any market panic. And now onto the most important part, the risks associated with the QYLD. As an investor of the QYLD or any covered call ETF for that matter, you don't get to benefit from the market going up. You're not going to get wealthy by buying and holding this ETF as such, but it's more there for its high dividends. And you're not going to get those total market returns because of this covered call strategy. The QYLD isn't really going to get any share price appreciation, and that's because if the price of the index goes up, the shares are called away by the buyer as we looked at earlier. The next risk is that the past performance sucks. Remove the dividends and you just have a fund that is doing nothing. The capital appreciation over time is flat or even negative since inception. Another risk is that investors can be really drawn into this fund through its high dividend yield. But as I always try to say, a high dividend yield is not the only thing that you should be looking at. Another risk is that it's poorly diversified. We're only really looking at those tech companies. But what I will say is that they are really high quality tech companies. Another thing that we need to think about is this high yield really sustainable? As soon as the tech market starts dropping, this yield is probably going to take a big hit. The QYLD has pretty much been running in a bull market for most of its life. So what would happen if there was a bear market or even a recession? And finally, the QYLD does not grow its dividends. Instead, it just tries to maintain a steady high yield. This means that the QYLD may not be the perfect fit for everyone's portfolio. For example, those following a dividend growth strategy. If we take a look at these charts here, you'll see the QYLD's dividend yield. And what you'll see is there's been some peaks, especially recently when I believe they paid a double dividend, but mostly it remains relatively flat. Whereas if you look at this chart here, which is the dividend aristocrat Johnson & Johnson, you'll see a very different shape as they've been steadily increasing their dividends for 59 years in a row. Talking about dividend aristocrats, if you want to see the top US dividend aristocrat stocks, click here. And if you want to see the top dividend aristocrat stocks in the UK, click below.